Hello, my name is Tim Kraus with Kraus Accounting Group. Today we're going to go over the process of selling your accounting firm. Over the past 3 years that I've been in accounting, I have done 4 accounting firm acquisitions, currently potentially working on another one as well. So this is the process from my perspective. I'm not a broker. I'm a guy who buys and runs accounting firms. We have a team of just over 20. And this is what I do on a day-to-day basis. I was helping run the accounting firm before making this video. And after this video, I got to get right back to it. So the process of selling your accounting firm. So selling, again, isn't just finding a buyer, like I've said multiple times, and it's still true to this day. Really, buying an accounting firm is a relationship transfer and a trust transfer. It's a big deal to sell an accounting firm and to trust that your clients and that your employees are going to be well taken care of. And there's a lot of communication that has to go on about that, which we will get into later in this process. But this isn't like buying or selling a piece of land. Before I did accounting, I was in land for 3 years. I bought and sold about 72 parcels in 3 years. And whatever the buyer wanted to do with the land, if it was legal, fine. It did not matter. That is not the case when you are selling your accounting firm or when I'm looking at buying an accounting firm. Not the case at all. So your goal as the seller, if you have a staff, is to help protect your clients and staff, because that's really what you're transferring here. Also, your reputation you've built up over decades. And a way to get paid what is realistic. Again, I made a video on price and terms. You could see how you can affect the price with certain terms. And then, being able to set the buyer up to retain clients, because at the end of the day, unless you're getting all paid up front, which is not the way I buy accounting firms and pretty uncommon in accounting firms in general, the retention of the clients is what makes the deal actually work. So, slide number 1 here. The first step is that you actually meet somehow. I have personally met sellers who I've ended up buying their accounting firms from actually, it was technically a software ecosystem, which was kind of a referral. Me and a gentleman who owned an accounting firm both were using the same project management system, and we both had a history of land investing. And believe it or not, there's not that many accountants who have a history of land investing, so they connected us when we went from there. So there's also a referral network, other CPAs, because CPAs know oftentimes other people who are retiring, industry communities, and sometimes a broker, but that's not what I focus on. And actually, the way that I have met most of my actual most of my sellers personally has been through mail, through direct mail. I send people a letter. You might have received a letter from me. If you did, let's talk. No pressure. If it works out, great. If it doesn't, that's okay. Let's chat. So, through mail is a way that I have done a lot of encounters, a lot of talking with different accounting firm owners. Because accountants, for the most part, are really good about opening their mail. So, and you as a seller looking to sell your accounting firm, talk to more than just one buyer, if you can. It's not required. If you just want to talk to me, I'll accept it. It's okay. But all of the people I bought accounting firm from, they've talked to multiple people, and I've been one of them they've talked to. And I've talked to more sellers than I've bought accounting firms from. So I don't buy every accounting firm I talk to. We have to make sure it's the right fit on both sides of the table. Okay, so in that first meeting, your goal in this meeting, which I've done virtually and a lot of times in person, is really, is this a good fit? Do I like this person? You as the seller, do you like the buyer you're talking to? Because if you don't, very likely your staff won't and your clients won't. So that's a pretty easy one right there. You have to make sure that it's actually a good fit, because again, selling an accounting firm is all relationships. I've done a few first introductions on virtual calls. I've done more over lunches. Haven't done coffees actually, but coffee is totally legitimate. I usually want a longer term thing. And by the way, if you're an accounting firm seller and your buyer does not buy you lunch, I will buy you lunch. So, just saying, that's a pretty basic one right there. Okay, in this stage, this is the first fit test. I don't get into too much detail at this time, but essentially, do you like, for the buyer you're talking to, is their model, does it fit your model? Are they only a bookkeeping firm and you only have a tax firm, and they're not willing to learn tax firm stuff? Well, then that's obviously a pretty easy fit. What level of service do they provide to their clients? Because that can be definitely a challenge. Also, there's other things about technology and billing and client expectations, but those are different conversations which can be overcome, but all things to know is they will be different things you have to deal with. And then, oftentimes during this conversation, I will get into what are some general numbers. Like first meeting, I almost never see the profit and loss at this point. That will come in later. But basic size range, roughly how much revenue did you do last year? How many employees do you have? Those are questions I have asked sellers often at this point, just to try to get a basic idea to make sure we're on the same page. And this is a super important question that a buyer should ask you, and you should have a good answer for, is why you're considering selling. Most of the time it's been retirement, or want to spend time with the grandkids. One time it has been because someone wanted to go into a different industry. And then, this I think, I'm going to underline this one as well here. What is the buyer's view on staff and client care? Do they think they can't train staff? And therefore, you have to hire the best people you can, and if your people aren't measuring up, you fire them and you get new people? Or do they have a training regimen? Do they have a training process that they are willing to do with staff? With clients, do they say it's their way? Does the buyer say it's their way or the highway, and these are the 5 products I have, and if they don't fit into these products exactly, then I have no flexibility? That's something to consider. Like, we have a lot of flexibility. Now it adds more operational drag to my company, to my organization, but we have a lot of flexibility. We have people who tax, for example. 85% of our clients do tax entirely virtually, but we still do have people that drop off in person. As a matter of fact, it is February 5th. We have a bunch of people coming over tomorrow to the office to drop off documentation in person, to shake our hands and see who we are, and we're going to sit down with them and say hello and scan the documents and do that. Is the potential buyer you're talking to, are they willing to meet your clients at where they're at? And I'm not saying necessarily physically, even though there are a few clients from the last acquisition we did, we're going to go to physically go meet them where they're at because of age and mobility issues. But that's a kind of different conversation there. Okay, if everything works out well there, the general high-level numbers work, and hey, you like each other, you seem like you would, potentially be at least acquaintances, if not friends, in a different life, because you will be friends in this life if you're going to end up buying the firm, because you'll be connected for at least a little while. Then I would recommend going to the NDA. If you like an NDA, I provide a lot of NDAs all the time. It really depends on people's comfort level with the NDA, if they want it or not. But, and just for some differences here, typically when you're working on a broker deal, if you're a buyer and you're looking at buying an accounting firm, you have to send an NDA before you see anything, before you talk to the seller or have any sort of conversation. In private deals, from my experience, it happens after we make sure that there's a relational fit. Because if there's not a relational fit, then we're doing all this paperwork and I'm taking up the seller's time, the firm owner's time, when we don't even like each other. So what the heck's the point? Because this is a relationship. Keep on saying that a million times, a relationship thing. So the NDA should just cover some basic things, obviously, confidentiality, NDA non-disclosure agreement, you're agreeing not to say anything, and then essentially, it usually has a phrase in there on who's able to see. I have a partner, and also oftentimes attorneys, and then non-solicitation of employees or clients, usually for a certain period of time afterwards, unless it could be proven that you already knew them before, that you knew they were one of their clients. Case in point, let's say I have a friend who I've had for 20 years. I'm getting old. Different topic. I've had for 20 years, and they're doing accounting at some place, and later I find out I'm talking to the seller, and I find out they're actually a client. Now, I guess I'll talk to the friend. I'm not going to be soliciting them for accounting work or tax work, but I guess I'll talk to them. So, anyways, that's the basics of an NDA. Usually happens around this point. You make sure that you like each other, and then let's move forward from here. Make sure the initial numbers, the initial thoughts kind of work a little bit. Okay, now, this is why also usually I wait till a little bit later. This is essentially what's called a SIM. This is essentially a private sale SIM, a confidential information memorandum. This is used within a lot of, when you're using a broker, when you've talked to a broker, which I have talked to brokers, and I've looked at probably half a dozen or a dozen sims and haven't bought any through a broker yet, which hasn't been the right deals. Has to be the right fit. But this is essentially what a sim would be. So if you're a seller looking to sell, this is what I would recommend that you make, so that you could, hey, I'm looking to sell my firm. You could put this pack together right now and then have it, so that you could just give it to potential buyers once the NDA is signed. Good basics: 3-year P&L, last 12-month P&L month over month. And then if you have this one here, this will be added in the add back section. Kind of the cash flow, owner's distributions, add backs, which we're not getting into a bunch of what those are, but they're essentially, a lot of the smaller accounting firms are sold on what's called SDE, or seller's discretionary earnings. So you add back in the owner's wages and perks and one-time costs. This could oftentimes be a car or cell phone or internet, or things that the new owner wouldn't necessarily have to actually purchase. So that's kind of the financial packet. Then there's going to be the client revenue packet. This can totally be, and I'm totally fine with it being anonymized, where basically you're going to do, if you have books in QuickBooks, you're going to do your revenue by client over the last year. Then you could have basically all the different revenues, and then you just trim off all the letters except for like the first 2 letters of their name. So that way it's anonymized, but then you both can talk about, hey, client AB, I see this is going on with that client, and then you and the buyer can talk about those. So that's the anonymized client list there. I would also do sales by client for the last 12 months. This is really helpful to see the flow. If your tax firm is all in one time, do you bill all after the fact? Do you bill all up front? If it's bookkeeping, is the client list growing over the last 12 months, or is it declining over the last 12 months? Super important for a buyer to know that, because when they get in, they're going to find out anyway, so you might as well address it now. And then also, it is helpful for each client to have the service type. So what are you doing for this client? Because we could do so many different things. Are you just doing B&O quarterly filings, or are you doing full CFO services, AP, AR, bookkeeping, taxes? What are you doing for this client? That kind of falls to the recurring versus project. And then how much revenue are you getting from that client, or potentially a range of revenue if you are charging by the hour. And then this is just helpful for a little bit of expectations. It's not as near the frequency and touch points here, but that's for some expectation pieces. So that's the client side, because again, your business is essentially 2 things. It's your clients and your employees, and also your systems, because I'm a systems guy. I'll give systems in there too, but primarily that's what a buyer is looking at buying. So again, you can anonymize your employee census, the role and their pay. This is not for be to the penny. We're not auditing the financials, but how much are they roughly getting, like per hour or per year? And then also helpful to know, because this will help later with terms and stuff and just questions, what is your current tech stack? And kind of how do you process, and how is work delivered today, So, all right, so basically you have the three biggest pieces here. You have the money side, the client side, and then the staff. The staff side. So those are kind of the 3 big elements that you're going to be looking at, that you're going to need to prepare so you can give that to a potential buyer so they can actually see what's going on. So once the potential buyer has received this information, which is where I'm right now and with potentially deal number 5, but we're in negotiations. We will see what happens. Ultimately, if it's a fit, it's a fit. So now we're entering, this is the due diligence and discovery phases from the seller's perspective. But essentially, you will give the buyer this information and then give them a couple days, a week, be in communication, figure out something that's reasonable. But the buyer is going to review and start asking you more questions. So do not be surprised if there's follow-up requests, more clarifying questions, and then some deeper details into some of these things, because this was going to really depend on what sort of terms the buyer is going to be willing to do, because these are going to affect the differences between what you do here and what the buyer does here. That bridge, that gap that has to be crossed is going to be a consideration. Whether that's pricing, tech, whatever it is, that's going to have to be considered on both sides. as a cost of the transition. So, some basic questions they're going to ask. They're going to be asking about the clients. How do you communicate with the clients? There should really be a really care and understanding, and this is really good for you to see as a seller. If a buyer is actually like really digging into, okay, how do you actually take care of these clients? Because then you should kind of figure out that, or hopefully figure out that this is because the buyer is trying to figure out post-sale and post you not being there anymore, how are they going to take care of these clients? So, my opinion, that's also a good sign from a potential buyer. And then they will oftentimes ask, hey, who is kind of on the fence? All of us are always in the process of losing some clients and gaining other clients, whether they go out of business or what have you. There's a small percentage that usually churn no matter what, so that can be also talked about. And then this is kind of underpriced clients, what we potentially do. When was the last time we raised prices for these clients? Sometimes it's been 10 years, and we can't just jump them up to the current price. We have to have a plan to step them up little by little. Again, that goes back to an expectation thing that you're going to have to work out with you and then the buyer. So speaking of those expectations, slide 6 here, price versus terms. So now essentially we are getting into the buyer has presented, or you have presented, if you have a price you're aiming for, you have presented what you're looking for, a price and terms. Hey, I want all the money up front. My experience in accounting firm sales, incredibly, incredibly rare. All of the deals I've done have had some form of seller financing. The more I'm going in this, the higher the seller financing is getting, really, because there's so much risk in an accounting firm transaction. So the price is the dollars, pretty straightforward. The terms are anything else that creates value or reduces risk for the other person. Okay? So this could be a down payment, how much down payment versus seller financing, a retention and earnout, if some money is going to be held back in escrow, which is also a retention and earnout piece. And then transition support, expectations. We've had some with zero transition support, not because they didn't want to, because they had to, unfortunately. But zero transition report, we've had other support and other ones where they have been supporting us for a whole year. So it really depends on what they're looking for. A non-compete non-solicit is pretty common. Obviously, if the buyer buys the accounting firm from you, and especially if they put a whole bunch down and then you go and try and steal the clients later, that's not cool. So please don't do that. But again, usually people I'm buying an accounting firm from want to retire, so usually it makes sense. We have it in there just in case. It's good to be clear. When the potential closing date is, this very often moves back as you get deeper into this, but we'll start with an idea. And then what happens to any outstanding AR, any sort of current work in progress or prepaid fees. This is a pretty important one to make sure you get all pounded out, but that can all be negotiated. Okay. So this one really, I've had it both ways. Who goes first? I've really had to go both ways on saying that. In general, I've given a price first. But as a buyer, but not always. So you need to figure out what you need. How much do you need now? Do you need the cash now? Do you want the cash now? How much are you willing to give up for getting the cash now versus getting the cash later? Because typically if you're waiting, it reduces the risk for the buyer, so you're going to be getting more. And then how long do you want to have for your earnout period, which is how long do you want to be potentially exposed is an extreme word, but able to have the amount paid reduced, because if you lose a bunch of clients right after you sell, then oftentimes then the value of the note for seller financing will go down. And then what work are you willing to do post-transition? This can change, life events do come up, but this is something you should be considering. Again, the longer you're willing to do this, there's varying degrees of there's different thoughts. If you have a very small business, we're used to hold all the relationships. In general, the longer, the easier transition is. I found the higher success rate of transitioning clients. If you have a larger business, it can be much faster, because therefore it's more about the team transitioning to the new ownership. So a letter of intent, I think out of the 4 deals I've done an LOI 2 times. So this is just a very high level, how everything will be handled. Basically all the important parts of the contract, because later we're going to get to giving it to lawyers and they're going to add everything else. So now we are entering the contract phase. So there's two different ways to buy a business. There's asset sale or there's a stock sale. So an asset sale is where I'm going to buy basically, let's say it's one of the smaller firms I've done. I'm basically buying a warm handshake. I'm buying you're going to send off some letters. You're going to send people my way. And then if people approve or want to move forward, then you're going to send me their tax returns for me to be able to put that in our system. That's pretty much an asset sale where you're buying the assets of the business, but not the stock itself, the stock being the stock of the LLC if the business is an LLC. So then there's the stock sale, which does assume liabilities. This is better if you have more long-term contracts, or it's more valuable if there's more long-term contracts. But from a buyer's perspective, it is more risky. There are tax differences. I am not the tax partner in Krause Accounting Group. That is my partner and mother, Miriam. So I do not know all the different tax differences, but she is very willing to tell me every time I bring up a potential deal. So, but the contracts will often include goodwill, what is ultimately being purchased, any sort of retention clauses. I know you might not like a retention clause as a seller. You want to just have it all guaranteeing how much money you're going to make, but at the end, this is not one thing. An accounting firm is not one unit. It is hundreds of relationships, dozens of relationships have to be transferred. And then any sort of obligation transitions. This could be leases, like we've bought a place that had a lease before, and this could be taking on the lease and stuff like that. So that's important for that to be in there as well. And then how, obviously, the payments will be made. Reps and warranties. And then this here, which can be in this phase, it could be on a separate email. But the implementation plan for reference is really important to, now again, you don't have to have the lawyer say this, but basically for you and the buyer, I am a buyer, but for when you're selling, talking to the buyer about, okay, what is the plan? What does the next 3, 6, 9 months look like? We're going to go into that a little more here later. Actually, we're going to go into a little more of that here now. So the implementation plan, hugely important. If your buyer doesn't have an implementation plan, or at least hasn't talked to you about an implementation plan, I would be very concerned, because you're gonna sell the business, and unless you're getting all the money up front and say screw it, okay, that's fine. But you're gonna sell the business and walk away, and if there's no implementation plan, it's just rough. It's just not fun. So I'll build it before the closing. So deciding, basically a whole lot of decisions of letting the news out. Some businesses we bought, they've been telling everyone for years they're going to be retiring, so the news was kind of already out even before it was all done. Other ones, we've been very under the radar, very, very quiet about it, and that's just the difference. I honestly prefer under the radar because it makes it so you can help control the narrative and help control how that transition looks to everybody. But who tells the employees and when? Who tells the clients and when? Usually I found this better coming from the seller than from the new buyer, because from the new buyer, they're just like, who the heck are you? So it comes from the seller, usually on a CC'd email with, then honestly part of the implementation plan is, what do those clients need to do to take the next steps to move forward? How the instruction is going to happen, and then how we're going to handle the data flow. Because whether we're buying bookkeeping clients, tax return clients, CFO clients, when you buy another accounting firm, the clients that you have, that you just sold, if you're selling an accounting firm, will assume that like a snap of a finger, all their data is now with the new firm, which is great because then it gives the new firm opportunity to get things going. However, we know that's usually not the case. Also, if we're going to be sharing logins across firm to firm, that can be kind of scary depending on what sort of logins we have. Some logins we have are full bank account access logins. And that could be kind of scary to want to share those from firm to firm. It's like, hey, make your own user account and let's go from there. So I'm saying have it in the plan, because the client's expectation is going to be very, very important here in this whole thing. Also knowing what sort of reports they receive is super important, because even if they're moving from your system you're selling it to a new system, the client doesn't care. They want their normal reports on the 10th, on the 15th, on the 25th, on the last day of the month, whatever it is, to look the exact same, even though they've moved entirely different systems and potentially different portals, different client management systems, etc. There's some training we're going to have to do, but the least amount, the better. So that is the plan stuff. Have a implementation plan. Even if you don't have a buyer yet, maybe build out what you would want the implementation plan to look like. Therefore, when the buyer comes along, you're like, hey, this is how I think we should handle this, and see what they say. That'd be great. That'd be cool. I'll be down for that. Hasn't happened to me yet, but if you want to make one and sell your firm to me and then reach out, I'd like to see your implementation plan. If not, I'll make one because I do those pretty frequently. So the announcement. This is a super sensitive part. This is where the rubber meets the road. This is where things can go very fast, all sorts of directions. So I will highlight this part here. People are concerned about their job and their pay, which they should be. How is that being handled? Don't be like, hey, we've sold to Kraus Accounting Group. What's going to happen to me? I don't know. No idea. That's terrible. Don't ever do that. Please don't ever do that. You have got to have a really clear plan for the employees. And that's where stability messaging, because even here's the thing, even if we come in and have a big old stability message piece, now we'll mention some things that are going to be changing, and we'll mention things that are going to be staying the same, because that's a change is always negative. So hey, this is what's changing, this is what's staying the same. It doesn't matter. Every employee that night is going to look on Indeed for what jobs are in the market. That just is what it is. So having a clear plan, and that's if you do a good job. And having a clear plan on this is going to be super helpful. Okay, because it's a big relationship transfer. Those might have been your employees we bought firms where people had employees for 18 years. Like, that's a big transfer. It's challenging. So to the clients, again, this is all part of the plan, part of this plan, and part of this plan. But having this plan orchestrated is incredibly important. Is it going out through an email? Is it going from the employees to the clients? Is it going from the owner to the clients? Is it going from the owner to the clients with the employees and the new owner CC'd? Is there going to be a calendar link or some sort of scheduling link that's going to go from the owner to the employees to the new clients with the new owner CC'd? How is it going to be handled? Stupid important. So, and again, it's going to depend. Why I'm not saying this is the answer, hey, this is the way you do it, because all clients are different. And your clientele are going to be different. So how will your clientele receive it? A lot of clientele that are older, they receive it through letters. We do that pretty frequently. And in the last letter we did to the small tax firm we bought, we said, hey, we are honoring the price that you guys paid last year. Because we wanted to get in front of some of that change resistance, because change by itself is negative, period, and end of sentence. So you have to help get in front of that. Let them know what's going to change, let them know what's not going to change, because they're assuming everything is going to change. And you let them know, hey, we can still take care of you for tax return. We're still going to do your tax return, and this year your prices are going to be 10% more than what you paid last year. Or this year they're going to be doing the exact same price. That's all different options there. But again, being clear on that in your communication is super valuable. So, also, the time load, tomorrow we're having, I think, 4 or 5 in-person meetings. There's a good amount of time load in the transition, but we have found that once people get past the first year, because really that relationship transfer, way easier the second year. So just have that in mind. Now, your 30, 60, 90-day access piece here. Now, honestly, depending on how you do it, you may choose to have the employees know right at the beginning, but then not let the clients know until it's 60 days. That's a possibility. It depends how you want to work on access and logins and kind of how fast the frequency of the service that you're providing. Also, if you're doing an asset sale or a stock sale, this is much easier in a stock sale because you're literally buying the LLC, so you're getting all of the contracts. But you could choose to have these at 2 different times. Now, don't have them too far apart because the employees oftentimes will let them slip, but it's a possibility. So, and not always, but depends on the employee. But really, you are going to be massively getting the work done in the first 30 days. You're going to want to make sure you're giving everything to your buyer. And you being the seller, there's probably half a dozen things you have forgotten about, especially if you don't have written down processes that are going to be workflow issues. Oh, I forgot about that login over here, over there. Oh, I forgot for that one client, we used that particular website that then has the login in this particular folder. That happens big time. So typically we try to do then within our 60-day window, really stabilizing the process, hey, consistently delivering them work, letting them still see, because we're a professional services provider. The people who we're serving want to receive professional services. Letting them know, hey, they're still receiving those services. And that they could trust us with that, because again, it's all relationship business. And then 6 to 12 months, this is where you can start having pricing adjustments, which is where I've talked about before, where we have a base price that we raise, then we also have a catch-up rate that we raise people at. We don't usually raise people from their current base. Let's say that, our other rate is way up here. We don't usually just raise people up all at once. We usually will raise them up over a couple years. This could be a 3-year process. I don't know why my pen's being weird, but hey, it is what it is. There we go. This can be a couple-year process. So, and then also obviously if we had any sort of retention issues, measuring those to see if they go within any sort of retention clauses. And then depending on how long the phase-out window is, the seller support's tapering off, and this time is not uncommon for a couple-month phase-out period. So, at the end of the day here, the seller, you want to get paid. And you want the relationships to stay intact with the business so the buyer can get paid every month by providing those professional services to the clients. Super valuable. You need both sides. If you don't care about the relationships, it's not going to work. So the seller notes intact. The retention and earnout metrics are monitored, and then you are done with your obligations, and we're able to go spend more time with the grandkids, go do whatever you want, go crab fishing, what have you. So the best outcome, your clients are cared for, and the new buyer retains the clients. Really important. Try to make it as best case scenario for them as you can, because that's where the money's coming from for you to get paid. The seller gets paid, and the relationships stay positive. There will be change. There will be some friction that will just happen just from there being change. But in general, you want the relationship to stay positive. So never talk bad about your buyer. It's just so not good. If you're talking bad about your buyer, you messed up way back here. This is where you make your decision if you like your buyer. If that guy, that gal is the buyer for you, you make your decision here. Now, of course, if they're acting terribly and is a bad actor after the deal, that's a bummer. That's a really crap situation. But for the most part, you make your decision right here, because it's not going to do you any good to undermine the whole deal. So, quick checklist here. We're going to have preparing, deciding, and then the expecting phase here. So, one thing you can do right now is you can prepare all these different pieces here. You can make basically your own SIM, your own confidential information memorandum. Again, it might get outdated after a little while, but you can basically put all those pieces together. You can start thinking about what's your ideal price and terms? How much transition support? This is the big one. And what ultimately are your absolute non-negotiables? Like, like the staff retention have to be in there or not, or does staff retention not matter as much to you? Now again, staff can choose to leave if they want to leave, but from the new buyer, can they let them go? So most deals we've done, that's always been we've kept the staff, except only one time when it was all part-time staff and the buyer and the seller didn't even want to have them in the deal. So and then what you can expect once you get going is a lot of due diligence questions, a lot of client communication work, because people are going to be concerned and nervous, or just going to want to wish you well for your retirement, and then a transition period. Even with a tuck-in, which I call a tuck-in, when we buy a list of clients and they come into to one of our brands. It's not when we keep a separate brand, separate location. It depends on the size and several factors, whether we'll do what's called a bolt-on, where we'll keep a separate brand and location, or if we'll do a tuck-in, where all the clients will just come in to the main brand. So that is my overall process of how to sell your accounting firm, step by step here. Hopefully it's helpful. My name is Tim Kraus with Kraus Accounting Group. If I sent you a letter or if I didn't, and if you want to sell your accounting firm, I am still looking to buy accounting firms. Please reach out. Thank you. Have a good day. Bye.